Welcome to Wealth Mavericks, the podcast where we help doctors unlock the secrets to building generational wealth. And today we're talking about defined benefit plans and whether they're a good idea for doctors looking to save on taxes.
The people who were advising him, were they bad advisors? Not necessarily, but the only thing they had in their hand was a hammer. So if all you have in your hand is a hammer, everything looks like a nail to you. And so when he called them and had this surplus income and he's like, what do I do with it? They hit that hammer onto what was, something other than a nail.
You're putting $60,000, $100,000, $150,000 into a pension plan or retirement plan. You're getting a tax benefit, but the reason why you still don't feel like you have capital is because you're giving away 50 to 70% of it to get a benefit to lower your tax rate, but doesn't necessarily mean that you're getting money back.
So Bob, this is a topic that has come up on several calls for me recently. So when that happens, I decide let's make it a podcast episode because if a few doctors have the same question, I'm sure many out there are thinking about it too, or are facing this in their world. So a defined benefit plan, I had to look it up and learn more about it. A couple new members, a couple prospects have come and said, I'm doing this. Is it a good idea? Or when we run their numbers, they tell us I'm putting 60,000 or 100,000 or whatever it is per year into a defined benefit plan, of course, to save for my future, but also to save on taxes right now. And so I wanted to get your thoughts on, is that a good idea? And how does someone know if it's a good idea?
Yeah, it's a great question. And I think it pops up more with doctors because they tend to have higher margins. And what I mean by that is that they get paid a fair amount and they have discretionary income. And so when they talk to their CPA or their tax professional and they say, I got to figure out a way to reduce my taxes. And this tends to be the go-to for a lot of CPAs. Because the CPA knows from a tax perspective today what that can do on the tax return. But they don't necessarily know what it means long term. They don't necessarily look at it from a access to capital perspective. They don't look at it from when you decide to retire, how much tax liability you'll have. They don't look at it from any other perspective other than, can you get instant gratification? And I don't necessarily know if that's the right reason to go into a 401k plan or a defined benefit plan, a retirement plan. It is for retirement. And so I think the first question that should be asked, Aaron, is when it comes up is, can you prioritize tax savings and retirement savings? Which one's more a higher priority for you right now? And I would probably say 9 out of 10 will say the tax savings, because most of them are in their 40s, maybe entering their 50s, and they've got a tax liability and they're kind of sick of it. And they know they need to have some money set aside in the future, but they're worried about the money set aside today. They're worried about access to capital today. And so they want to save money on taxes. And so for me, it doesn't make a lot of sense if someone tells me to spend $100,000 so I can save 30. What happens to the other 70? Is that a good ratio? If I asked you, give me 70 so you can keep 30, would you do it? Hell no. But that's what we're saying. Mm-hmm. That's essentially what CPAs are saying. Go buy a new car. Go buy equipment. Well, I don't need equipment. Yeah, but you need the tax benefits. Right? And so I don't, even for our California doctors that are in a 50% tax bracket, still doesn't make sense to give away 50% of your money. And this goes back to the question is like, well, your guys' investment with you guys is, $30,000. What am I getting in return? To go check out that episode and the answer to that question. Mm-hmm. We'll have it down in the link for you so you can go take a look at it on your own. I think it comes down to access to capital is what you need for money. If you're a business owner, the answer is going to be different than if you're a high W-2 employee, but not much different. It still comes down to access to capital. And I think what we should probably do is an episode just talking about retirement plans and the specifics of the rules of how it's structured. We won't spend the time in this episode to do that. With a defined benefit plan, if you're somebody who feels like, man, as hard as I'm working, I really should have some extra discretionary income. I should have extra money at the end of the month or at the end of the year, but I don't. But you're putting $60, $100, $150,000 into a pension plan or retirement plan. You're getting a tax benefit. But the reason why you still don't feel like you have capital is because you're giving away 50 to 70% of it to get a benefit to lower your tax rate, but doesn't necessarily mean that you're getting money back. So you're literally putting 150 or whatever that dollar amount into a plan that is going to lower your taxes, but it doesn't give you anything.
Well, it does in the future, though, right? I mean, they are setting it aside for their retirement, and people do need to save for their retirement.
Well, yeah, they do, but that's not the only plan. Their priority is tax savings, right? But if they're complaining about not having cash flow, then it may not be a right fit for them. But again, it's the go-to, and Joe, you brought this up before, is that banks, insurance companies, and investment companies have a lot of marketing dollars. And so it is such a great, easy strategy for a CPA to say, set up a retirement account. It's like, if you don't own a home, what's the first thing they say? Buy a home, because you get to deduct the interest on the loan. But here's what I always say. Okay, go into $500,000 in debt. All right, not a problem. You still need a roof over your head. But you get to deduct the interest on your mortgage. Okay, great. But if interest rates drop, are you going to refinance your mortgage? 9 times out of 10, they do. So then you're really not doing it for the tax savings, because by refinancing, what'd you just do? You just lowered your tax savings by refinancing. Well, but my interest is lower, so my cost is lower. Yeah. But your CPA said to do it because you can write it off on your taxes. See what I'm saying? Is that the two sides aren't talking to each other. Is when you walk through it and talk through it with somebody who understands, let's look at the asset. Let's look at this, and let's look at both situations, both scenarios. Let's look at it holistically, and let's make a decision once we have all the information. That's how we do our planning. So I'm not saying a defined benefit plan or a retirement plan is a bad idea. Maybe it's just disjointed in the order of assets they should have. Maybe it should be an asset they have a little bit later on, because they've built up some other assets. They've accumulated some more wealth. And if it is a tax benefit in the defined benefit plan, you have more cash flow coming. Then you can do it. You can tie up capital. In fact, you can put more into it as you get older because of the way it's structured. But you still have these other cash flows. You still have access to capital and cash flow to where you don't feel like there's this crunch. Right? Joe, we had a member that we had met last December, right? You want to share that story of kind of how that conversation went in December, and then that conversation in late January, early February?
Yeah. I mean, literally met him. His speed of implementation of making the decision to work with us took a little bit too long. But he had exact conversation, and Bob, your advice to him was, no, I would not do that. I would do this instead. He didn't take that advice. We hadn't earned enough jurisdiction in his world. He contributed a significant chunk of money to that defined benefit plan, only to talk to us in the first quarter of this year. And do you guys remember Happy Gilmore, the movie Happy Gilmore?
Yeah.
And Happy goes back to his golf teacher and is like, I'm ugly, you're good looking, I'm dumb, you're really smart. It felt like that moment. He was like, you guys, I will never make a decision without your input again. Because the decision that he made put him into a scenario where he then actually had to borrow money and take out money to cover cash flow issues, because that's, ultimately what he needed was cash flow, not the retirement, but he was making a tax decision out of order. The people who were advising him, were they bad advisors? Not necessarily. But the only thing they had in their hand was a hammer. So if all you have in your hand is a hammer, everything looks like a nail to you.
Yeah.
And so when he called them and had this surplus income, and he's like, what do I do with it? They hit that hammer onto what was, something other than a nail.
Yeah. And here's the thing is, our advice wasn't based on a tax planning advice. It was based on business advice. Understanding a business owner who wants to grow his business, who wants to scale his business, is going to need access to capital. So we didn't make this decision or give this advice because we did have a better tax strategy, but at the end of the day, his decision was to tie up capital. And that's why I'm saying sometimes it may be a cart before the horse. It may be disjointed order of the asset. I'm not saying it's a bad thing. Maybe it belongs at the latter part of your decision-making process. Maybe a couple of years from now, it will make great sense. In the way they're designed, you can do catch up and you can do more than, but what you really want to do is focus on the here and now. And so that's the kind of the planning and the advice that we would give. And so any of these doctors, that's why I always say, I want to see a tax return, right? I want to know what kind of liquid assets they have, because that gives me some indication as to where the flow of dollars. If we have a doctor who, like you're saying, Aaron, says, hey, I just, here's my income and here's my spending, and there's a very small gap between it, but part of their spending is $120,000 into a pension plan. Mm-hmm. Well, this is what it actually looks like. You're choosing to make it like this, and this is uncomfortable for you. So how do we make it like this? And that 120, how do we put that 120 into some other areas that can help create your assets and create cash flow and allow you to have access to capital to where you're not tying it up? So, in which those assets would still be for retirement, right? You're building wealth. Yeah. So it's just not locked into this legal system that holds onto your capital and you have zero access to it until you meet certain criteria or you pay a penalty if you take it out sooner. Right?
Bob, can I ask you a question? I don't know the answer to this. You might know it. Somebody who puts a defined benefit plan in place, whoever that advisor is, can you give us a rough estimate on like what's the financial incentive for them to do that? What do they earn from doing that?
Yeah, so it depends on how they're using it. So if they're an assets under management AUM where they manage the money that you put into the defined benefit plan and they earn a fee, that's theirs, right? 1 to 1.5%, whatever their structure is. That's that. But if they're using an insurance company and they're using a group annuity structure, there's a commission that comes to them instead of a management fee. If they're putting life insurance into the defined benefit plan, which allows your deductions to increase and allows your premiums on your life insurance to be deductible because of the pension plan, that creates a commission of the life insurance within the plan. But what a lot of times they don't talk about is how you got to take that life insurance out of the plan. You have to buy it out. Right. And there's certain criteria with the IRS code of how.
But like what could that be? Let's say somebody is doing, let's say $200,000 contribution to that. What's the commission going to be to that advisor?
Yeah. So if let's just use AUM, assets under management, because it's fee based. And so let's say 150, and let's just say one life insurance policy for 50 grand. And 150,000 goes into AUM. So whatever 1.5% on 150,000, as it goes up, they earn a 1.5% on that as well, right? Or goes down. The 50,000 in life insurance more than likely will be very close to a $40,000 to $45,000 commission on top of the fee.
So this is my point. I need you, doctor, to understand that the advisors who are in your world, who are not holistic in nature, who are looking at who are the hammer trying to hit the nail, there's a financial incentive for them to do that. And so they may have the best of hearts, but they're also going to have the best of pocketbooks, if you do go along with that. Mm-hmm. And it's not that it's not a good tool for you. You just want to be 100% confident that it's the right tool for you at that right time.
But here's the thing too, is that a lot of times it's not just you, the doctor, that is testing for qualification. What I mean by that is that if you have employees, based on the design of the plan, you're required to give money to the employees, not just the fees of managing it and structuring it, and have a third party company that does the testing to make sure you're not putting more in there than the rest of the employees. There's a cost. And so a lot of times when these plans are designed, there's the design is, oh, doctor, you get 83% of the benefit of the contribution, which means that you're making 100% contribution and 17% of that is going away to others. That's a high fee for you to be able to take 83% to lock up that capital for a tax benefit. You get a tax benefit on the whole contribution of everything. But it goes back to that plan design. It goes back to the conversation. It goes back to the why that we have with you is what's our purpose? How do we organize these assets? Because we can do all the same stuff without tying up your capital with different strategies that are available. Mm-hmm. And wouldn't you want that? So now you have what you want, but you're able to have access to capital and grow your wealth to where 2-3 years, we do put that in place. And now we're doing it for retirement, not just tax benefits. So we change the order. It's a retirement plan and I get tax benefits, not I get tax benefits and oh, by the way, I'm going to retire.
Right.
Right. Which is the kind of the comment you made earlier, Aaron, right? That's the mentality of pretty much everybody in that. Well, I am going to retire. Yeah. That's not why you're doing it. Right. It's a small percentage that say, no, I'm doing it because of retirement. That's great. Good. Then maybe it is the right order. And you got to be satisfied with your cash flow being where it's at because that was a priority to you.
What's that famous saying? Like, if you find yourself in a hole, first step, stop digging.
Yeah.
Right. So it's like, I would encourage you, Doc, today, may today be the day that you stop digging, like get a plan in place, a holistic plan that's going to get you to where you want to go. Step number 1, stop digging.
Yeah. Well, this is funny because what comes into my mind, Aaron, before we close this up, is one of our clients that we're just onboarding. We're doing their previous last year's tax returns, chiropractor, great couple. But the wife was just like, are you guys doing all this to sell us life insurance?
Right.
Well, let me guess what her experience is.
Yeah. What's it been up to this point? That statement doesn't come out of thin air.
So there is a process. Again, it doesn't make those advisors bad. It doesn't make this or that. We have said very purposely in other episodes that we've built the infrastructure, the ecosystem of Terra Firma purposely for you. And the back end is extremely complicated, which we won't allow you to enter the complication of the back end because we want you to experience the front end of simplicity. Right. And allow you to be involved the way you need to be involved, but have a team that is making sure that on the back end, we're doing everything that's necessary to make it simple for you, but also to be effective for you. And so anyways, so that's, and I love your questions, docs, by the way. Keep asking them because this content's very important for you. And it's important for us to be able to communicate what's out there. We can't guess what you want to know. We do know you very well, but each of you are very individual and your experiences are individual. And so we want to be able to address this with the content and the strategies and be able to provide more and more information for you. So you can also go to my other YouTube channel, Asset Coach Tax Strategist, where we go through some of the philosophies and the thought process and the methodology of how we do planning over there. This channel is specifically for you to answer your question and content to that. If you want to get into some of the weeds and some of the conversation of why we do what we do, we go through my books that I've written and all that kind of stuff's over there. So if you want to get nerdy, we'll put the link down below. I can get nerdy.
Thank you. That was really good stuff. So yes, doctor, it could be a good idea. It could be a bad idea. It depends on your unique situation. We are here to help you navigate that. So if you're ready to talk to us, you can find us in all the places, on our website, on Instagram, on LinkedIn. Let's have that cash flow recovery conversation, see how much you might be overpaying, and then we can move forward from there. So we look forward to talking to you next time. Thank you for joining us. And until then, go be a wealth maverick.